Welcome to Ask Me Anything. Today I have with me Eric Joern. If I mispronounce it, Eric, just correct me.
You got it.
From Kaizen CPAs. They do accounting, and you have an awful lot of our clients, which many of those we have recommended because accounting is so bad out there. So you guys do a good job. So today we're gonna start out kind of by talking about profit and loss statements and why they might be important. And of course, if you're out there and you would like to ask a question, or if you have any kind of a question at all and you want to do that, please put it in the comments. Raleigh will be taking care of that for us and making sure we get those questions so we can get them answered. Let me start out here, Eric. I always make this kind of comment. I have seen, 10,000 P&Ls in my life, and I can count on one hand the number of P&Ls that I've seen that are actually accurate, well done, and give us the information we need, at least in the beginning.
Yeah.
Why is it so? I don't know, why is it so bad out there where there's so much inaccuracy and so much confusion around the profit and loss statements?
Yeah, sometimes we have that. We have that same question. But when we think about it, right, there's a lot of moving pieces to generate a good financial statement. So first, you have to have the right systems and processes set up. Then you have to have the owner side, or whoever's getting the data, collecting the data, doing the things, right? So is my shop management system accurate? How am I paying my bills? How am I running payroll? Am I using the right payroll software? Are those things happening correctly? When I'm collecting things, right, how often do I go to the bank and deposit cash and checks and do things like that? There's all these input factors that go into an accounting hub. And then across that, there are all sorts of different theories on accounting, right? Accounting really isn't black and white, right? Our job is to show economic reality for that business. So we need to show what actually is happening. Well, that's opinionated, right? And that's why, the Institute has a specific way that they like to look at a P&L versus maybe, Joe Schmo CPA on the street, right? And probably their goal is, what's the easiest way for me to file a tax return? And your goal is, go ahead.
I think so first of all, you're making it seem like it's very complicated and very hard. I don't see it that way myself. So that might be somewhere where I disagree with you. My accountant, we have a CFO in the company, and if we had an outside accountant, it'd be you guys. But they are tied into our bank accounts. So they see payments coming and going. They're tied into our credit cards, so they see payments coming and going. So all deposits are kind of recorded through the bank account. All outgoing monies go through one account or another, and as well as credit. And then once we determine what the P&L needs to be set up like, and we create we chart of accounts for that.
Exactly.
Then it seems to be like it's not overly complicated at that point, right? And I would agree with you that I don't think I would disagree in the fact that the numbers are going to say what the numbers say. I don't think that we can say, okay, well that number is not what I want, so I'm going to go see if I can't find another number. But certainly the Institute likes to look at the finances differently than maybe someone that's running a shoe store would look at their finances. And so that is probably challenging for you guys in the fact that you have, different types of companies you work with, that the P&L might look a little different than they might be for automotive.
Yeah. And there's a lot of noise, right? So if you go out, you go out into the Facebook groups and say, how should I have my P&L? And they're going to somebody's going to give them one direction, and then they're going to go to their accountant. They're going to get a different direction. And then they're going to go to the institute or their coaching company, and they're going to get a different direction. And all that noise makes it really hard for them to know, what do I exactly do, right? Do I need to have service advisors with the cost of goods? Should that load my wages, right? Payroll taxes, all those things. Do I need to section it up like this or that? We see a lot of that noise, I think, causing confusion. So we actually see sometimes when their financial statements almost look like Frankenstein, I'd say, meaning they brought in theories from different avenues and they put it all together. They said, oh, I like this idea, I'm going to implement this. I like this idea, I'm going to implement it this way. And then half of it's right here and half of it's here. And one of the things that we always say is, I'd rather have a financial statement that's consistently wrong than sometimes right. And I know that's a weird comment to make, but think about it. We're always measuring performance based on relativity, right? Did I improve from this prior measurement point? Well, if I'm constantly changing how I measure, I'm never going to have a relative measurement.
But that's also probably one of the more difficult things for you guys is that, whenever we've changed accounting a couple of times in our business, in the, 15 years or so we've been in business, we've gone through, I think we're on our third different accounting. And every time it's like, well, we want to use QuickBooks and I want to use Sage. And so we want to reset up. So if I'm not set up correctly in the first place, then I come in and I go, okay, I want to get set up this way. I might be getting different numbers or looking at different numbers than I had previously, which has got to be a challenge, right?
Absolutely.
So at the Institute for Automotive, the way that I learned it was I want to have as my income, any income source that I have that's over, say, 2% of what I do in business. So if 10% of my business is tires, I want to have a tire income separated out from labor income and parts income. And then if there's a sublet income, I want to have sublet. And if I'm doing something like some states, we've got smog or we've got safety, I want to bring that income different because those things have different margins that I want to be able to look at. Yeah. And so I want to have a relatively, say maybe 7 or 8 categories. Sales tax is in there, but it's a pass through. So, but it still has to be accounted for in income. And then underneath that, and I think you have an example of a P&L that we can kind of pull apart here. But underneath that, I want to have the same categories as my variable expense. And that way I can see what my gross profit is. And I'm trying to make sure that my parts profit is right, that my labor profit is right, that my sublet profit is right, so that at the end I have the right gross profit.
Exactly, right? I mean, if we want to step back and say, hey, our core framework for a good chart of accounts on a P&L is going to be, if I have a sales category, I should only have a corresponding cost of goods category for that. So if I add a sales category and I have no cost of goods, right, is that truly a operational revenue item, or is that maybe what we call other income, right? Miscellaneous income that, for instance, if we have a investment account, right, and we're getting capital gains and dividends and fun things like that, we're not going to report that. Or maybe I sell customer doesn't pay their bill and I keep their car and then I resell that. Well, the gain
wouldn't you handle that as a more on the balance sheet and then bring that in under the net profit as a additional income or a additional loss or whatever under the
exactly
the net?
A non-operating gain or loss on the sale of something, right? And it kind of goes back to your 2%, right? If it's not greater than 2%, we're creating distractions by adding that up into sales. And that's really one of the things that I like to focus on is we'll see a P&L. You've reviewed 10,000, right? I believe that's considered mastery when you hit 10,000. Yeah. And what we see is what ends up happening is there's a lot of noise added to a P&L. And what I call by noise is we have accounts, and we have all these accounts added and all these things, which in one respect I understand, right? I want to know if somebody's charging me more than they charged me the month before. Do I think my P&L per vendor should be per vendor to review that? Absolutely not, right? Because then we start missing the big picture. I'll go into...
I can't imagine looking at all that data.
Yeah.
I mean, there would be no way to really bring it all together and try to figure it out.
I'm an accountant. This is what I do for a living. And if I'm looking at a P&L that's 5 or 10 pages long, I'm lost. I'm burned out through part of it because you can only process some. Jeff Bezos, I think it was, once said, if I can come in and make 3 good decisions in a day, that's a great day.
Yeah, I don't think I disagree with that at all.
And if you can look at if you're looking at, and I think about it on the same way with your P&L, right? If it's 5 or 10 pages long and it has all this detail on it, right? Making a determination on each individual account is almost like a decision, and you're going to get fatigued after so many of them.
But you have an expanded P&L. And you have a simplified P&L, which is usually a page and a half to 2.5 pages at the most, the simplified.
Correct.
Right? And that's how I want to kind of see my business. I mean, I want to see my business in chunks.
Yeah.
What was my income? What was my direct expense for that? And then what was my net profit? And then what are my different categories? I think we have a thing called a composite, which is different than a P&L. It takes point of sale data and P&L data and kind of puts them together and makes the decisions for us, does the math.
Yeah.
Right. So how much did we lose because we weren't productive? Oh, we lost $17,043 this month. Right. What was our average repair order? Oh, it was $1,059.83. So I think that you want to look at your kind of in chunks. I look at the income. Did the income match the income that our goals and targets? Then I look at the expense, and the only reason I'm really looking at the direct expense is because I want to know profit margins in certain areas because I know what the margins ought to be, right?
Yep.
And then I'm looking at my overall gross profit. Did I depending on how my P&L is set up, is it 64%? Is it 74%? Mm-hmm. And then I go to the bottom line and I look at net before I go through everything else, right? Did I make my 20% net profit bottom line? Does that make sense? Is that how you do it? Or would you recommend a different way to look at that?
Yeah. No, that's a great way. And I'll give you an example. So I QC before our client's financials gets out of our onboarding process, which is our creation process for somebody's accounting process system, to our production team. I QC all those financials. And the other day I was reviewing one and I look, service advisor costs and technician wages were at significantly low margins or high margins. The costs were very low. And it made me question, hey, how are they accomplishing this? I think tech costs was around 20% of tech labor or labor sales, and the service advisor cost was around 3%. Well, then I go into the operating expense section, and we have some other roles in there, like a shop manager and shop foreman. So that made me go back and ask my team. I said, okay, I know they told you that that's what these roles are. Now we need to ask the next question. Are they in production roles, right? Is my shop foreman, are they producing billable labor hours? Because if they are, then they need to be included up in tech wages. And same thing with my store manager, right? If they're performing a role of a service advisor, well, then they need to be included with the service advisor. And all of a sudden, when you move those wages up, now we're more at realistic category or ratios, right? Our gross profit looks a little bit more to what I'd expect. And it's a very different skill to look at a financial statement to expect what it should be than it is to say, I'm going to put the inputs in. And I think if I put the inputs in, it comes out right. You have to review a financial statement with the thinking of what should it look like?
Well, I think when you've looked at many, right, there's a point where you say to yourself, okay, this is out of whack, right?
Yeah.
That's my fifth step. Once I've looked at my net, then I'm going, okay, what do the expenses look like and where are we out of whack, right? If my labor cost is 20% of my labor income, I'm either not paying people enough or I'm not accounting for all the income. It's somewhere else, right?
Exactly.
And we see that all the time. In December, I don't even want to talk about December P&Ls for people because so much is thrown in different places. But we
Get to clean up the file of tax return.
Yeah. It's amazing to me sometimes how badly it is. And what I'm trying to do is figure out, I need something to compare to so that I can then go, okay, we've got a problem here, right?
Yeah.
I had a $35,000 charge on one of my accounts, and we lost $31,000, and we had a stellar month as far as sales go. And you're trying to figure out, okay, where did that money go, right? And there was $35,000 for, I think it was their tax, their property tax. Mm-hmm. And it was all dumped in 1 month in one pile. And then there was another $20,000 in owner wages because they paid the tax, right? So you see either a bonus or a dividend or whatever into the owner wages. And you're like, okay, well, we made $25,000. We didn't really lose 34 on this thing. But I think you need, at least for me, when I'm looking at my financials, I need to know that we're profitable. I need to know that we're profitable enough. And I need to be able to point out the 2 or 3 or 5 areas where we're not hitting the targets the way we need to hit the targets. And so I agree with you. I think I wouldn't say consistently wrong is better than inconsistent, but I want consistent data and consistent reports. Now, here's kind of another thing that I like. I like to see my columns. How you have here's the categories, and then here's the income that came in, here's the expense. I also like to see in there a percentage of what the sales was. Yep. So with the number, I like to see the percentage. And then I like to have a second column right next to it that is last year, this month. So I can compare like data with the percentages. And then I like to have a third column, which is the last running 3 months. And the reason I like the last running 3 months is because these guys, shop owners, do unusual things with how they record stuff. Like I might buy $10,000 in oil in 1 month. Mm-hmm. And instead of putting it into inventory on the balance sheet and then dealing with it in the P&L as I take it out of inventory, I just put a $10,000 charge, and it looks like my parts margin was completely blown this month when it really wasn't. So if I can see a running quarter, like 3 months, it will kind of leverage that, average that stuff out. Do you guys recommend that they account for things like $10,000 worth of oil on the balance sheet and not on the P&L, or how do you recommend that be done?
Yeah. Our ideal setup for parts costing is purchases go to inventory. And when we close a repair order, we journal entry the costs into cost of goods. So that's true parts costing. I mean, it's what we as accountants, and this is what blows my mind. This is what we learned in college. I took
Yeah.
cost accounting. That's exactly how they taught us to do cost accounting. But then we go into actuality, and I get it, right? If we're filing a tax return and that's it, we're just going to, when the money goes out, that's when we're expensing it. When the money comes in, that's when we're recording it as income. But if we're trying to measure actual performance of the business, you have to consider what are the economic realities of that month, right?
Yeah.
It's not, we bought bulk oil. We're going to use that oil over the next 3 months. If I expense it all this month, I'm going to make major profits the next 2 months. We need to normalize things. And that's why, again, you look at a 3-month trend because that starts to normalize things. If you look at one of our favorite reports is a trailing 12 months, meaning I get to see every single month for the last 12 months. And I have actually an example of this that we can pull up and
go ahead and pull that up.
Yeah, let's pull that up and let's talk about the benefits of looking at it this way. And now this is more of a, hey, I'm finding trends that are happening, but also I'm finding abnormalities, right? There might be something that sticks out. So your $30,000 property tax bill should stick out, right? Because it's going to say 00000, then $30,000.
Right.
Well, and then we know, hey, the right process for that's actually, again, it goes onto the balance sheet. And I know our title of this is reading your P&L without the BS. And I think BS might be balance sheet or it might just be a fun title. But
it was probably a fun title.
But again, right, that payment should really go, depending on how you're paying property taxes, should either be a prepaid or you accrue that throughout the year. And then when that payment comes out, it all hits the balance sheet, right? Again, the balance sheet is our holding place to normalize our financials, make sure they look consistent month to month.
So it sounds to me like you're recommending accrual-based accounting and not cash-based accounting very much.
Absolutely. And what we like to use the word modified accrual accounting because, are we going to say we got our internet bill, right? Largely the same bill every month. Does it make sense in our accounting process to enter the bill and then mark the payment, or we just post the expense right when we pay it? Because it's the same bill every single month. We're going to treat that probably in a cash basis format because it doesn't materially affect the financials. And it's more practical for a shop owner that's handling their own books to do it that way. Now, what we want to do is we want to highlight those major expenses and normalize them over time. All right. We are going to apply accrual treatment to the most impactful items on a financial statement because we want as reliable results on these financial statements as possible. So
we're looking at a P&L here. All of the names have been changed to protect the innocent.
Yeah.
What is right about this?
Yeah. So they started going in the right direction, right? So we got we have our parts sales, our labor sales, there are some things that kind of get out of hand a little bit. They're in weird categories, right? We got this random $15,000 here. You don't really like seeing all those. You don't like seeing things that are lonely on a rolling P&L, right? We should
when you have two parts sales categories with the same titles, right?
Yeah, I think it's just a parent title. Again, right? It's, hey, they made some mistakes. They didn't know what to do with that dollar amount. And then we have good bones here, right? We have labor sales, we have parts sales. Maybe there's a couple items here. We got subcontractor sales. We got hazmat, right? Those are all your greater than 2% items. And maybe there's some slop in here and whatever, that's slop. And then we got things like we talked about December P&Ls, right? Here's all your year-end adjustments, clean some things up, of course. Yeah. Probably the tax accountant jumping in there and just making some adjustments so they can file a tax return. Again, I get it. That's a direction that needs to happen, right? If you don't pay your taxes, you end up going to jail or your business gets shut down. It needs to happen. But it doesn't help us make good decisions about our business. But we have those good bones in there. But we got all these extra accounts like parts sold to third party. We have Are we really measuring that any differently than our normal part sales? If not, that's just noise. On
It ought to be
P&L.
in the parts pile. It's not enough.
Yeah.
Don't get me wrong. We have companies that sell online, so they may have 20% of their part sales be online sales, and we're not looking for a 58% margin on online sales, though that we're looking for different margins, and so they will separate online sales. But if you're occasionally selling some parts to yourself or to your techs, just put it in part sales. Don't divide it out in a separate category.
Yeah, exactly. It creates noise, and there's a way to handle it inside your shop management system, so that way it translates to the financials the right way when you do that. Ideally, right, if your technician is buying parts, do we want to write a repair order and do it that way? Ideally, they just buy them either directly from the parts vendor.
Well, ideally, but that in reality, they're probably not, right? They're probably, the shop is carrying them at some point often. At least that's my experience. My experience is that the bulk of part sales through shops, the shop is creating a ticket or something and then charging the tech when they get their paycheck or, once a month or whatever. And certainly, if that's what you're going to do, then you need to be creating a ticket because you need accountability for the cost and what you charged and the money that came in. So
if it runs through a shop, there should be an RO on there. Yeah. Any car that touches your shop has to have an RO. Any part that gets purchased through your shop has to have an RO attached to it. Otherwise, you lose accountability. The minute you say there's exceptions to that, you introduce the opportunity for theft, you got waste, and you lose accountability for it.
Yeah, invisibility creates lack of accountability. The other thing is, having had an audit or two, if there is slop or things that are missing, then the IRS gets to make their best guess, and their best guess is never in your benefit.
Yep. And it gets even worse. You start getting into state sales tax audits, right?
Yeah. Did they pay the sales tax on that, right?
Sales tax, use tax, they pay it on the glove, right? The minute they find one thing, they're digging deep, right? They run somewhat like a business, right? If they don't find any evidence up front, they're going to stop digging pretty fast. They see something, if they see disorganization, slop up front, if they look at a set of financials and it doesn't make sense, they're going to go digging throughout everything. And
the other
sales tax are the worst.
Yeah. And the other thing I think that shop owners, the average person probably doesn't understand is that the state sales tax is collecting sales tax from thousands and thousands of businesses. So they have data. And they have data that basically says if you're buying X amount of parts and you're in this type of business, that you should be paying X amount of sales tax, right? And
100%.
And if you're outside of their window, right, the bell curve, that's an audit or that's a fine, right? Literally.
They're going to look to triangulate your sales tax returns to your financial statements back to your income tax return.
Yeah. So and the IRS does the same thing. They have data on 200,000+ automotive shops that have been filing taxes. Now, I would think that would be really confusing because of how many bad P&Ls I've seen, right? But they've normalized that data as best they can. And if you're outside their windows, then they want to look a lot harder, right?
Absolutely.
So on that P&L that you have, there's an awful lot of just crap, right? Tech A, B, C, D. Why do you have that noise there, right?
Yeah. But it's the right thought process, right? In our cost of goods, we have our labor costs, right? Yeah. So they have the right idea. They know what they need to measure. And then they added complexity. They added noise to it, right? We're not making business decisions based on what we're paying that technician on our P&L. We're going to look at that cost relativity. And then we're going to look at things like, hey, what was that individual's efficiency? That's not a measurement you get off your P&L. right? You have to use
that's a
something
composite.
like
That's a different data set.
Exactly.
So I would only have the payroll category. That's it.
Yep.
And it would
just
all
the
be
one item for technicians.
Yeah. And then I like to see the text divided out and above the line, and then sales below the line, and my management people below the line. And I like to see sales broken out from the rest and text broken out. Those three categories are kind of a necessity for me because I'm trying to manage sales cost and tech costs and then fixed expense costs, right?
Absolutely. Yeah. I mean, we even have, more noise here. Again, right concept, shop supplies we have here, and we're probably charging shop supplies here as an income line. So we have the income and we have the cost line. That's correct. But then we add things like delivery and tax. So not only do we have, we can't make any decisions on those, and we don't, right? That's the cost of acquiring that shop supply. We don't need to break it out. That's creating more work.
Well, and they created a category for tax because at one point they paid $10 on tax. And so now I have a whole new category that creates, instead of just throwing it kind of in the pile.
Yeah. Well, and this is again where I get to the point of there's so much noise out if you go out and you just try to figure this out on your own, and you're getting information from there and QuickBooks, and you're doing this, and now I got my shop supply invoice on here, and here's my costs for my shop supplies, but then I have my costs for my delivery and my costs for my tax. So I could understand why somebody naturally just says, I'm going to enter it in like that. And actually with wages, one of the funny things that we see it all the time, I don't think that in this case it didn't make sense for it to look like this, but we'll see that the wage cost is actually entered as the net check that goes to the employee.
Oh,
so they run their payroll, and their federal withholding, the IRS is in payroll taxes and their 401k contributions and retirement, and they only captured the net check. And I'm like, no, you're paying them. They're choosing to take some of their money that you paid them and give it to those different parties. That's still just their wage. That's not the net check. But hey, that's what came out of my bank account, right? So if I go and I run payroll in QuickBooks, it's going to come through as a net check to my employee.
But not really. I mean, because we have employees, and we're paying FICA and FUTA and workers' comp, and workers' comp's not a cost that is their cost, it's my cost. But correct. FICA and FUTA is, at least in part, their cost. Because we're taking money out of their check. And then if we have a 401k here, so we take money from your check and we hold on to it, and then we do whatever matching, and we pay out like we would FICA and FUTA. And so we have to, whatever your whole gross check is, that's what needs to be reported.
Exactly.
And then the other things that come out that are your costs, we don't really care about. It's the things that we pay that we care about as far as the company goes.
Exactly. And again, right, if you only build your P&L based on where the money comes out of the bank, right, the batch that goes directly into your employees' accounts, whether it's direct deposit or checks, right, that's a separate payroll. I mean, you might have something called impounding done if you're using a payroll provider. That's a whole different story, right? And then there's no making sense of how that money happens unless you get a breakdown report from them. But yeah, if you're only following the cash flows, right, you're going to improperly account for it. And we see that time after time after time. Again, when those expense ratios don't look right, hey, it's time to dig in. Let's figure out what's the answer. Okay. Yep. We found out that we didn't record payroll right. Your payroll taxes look super high, right? They should only be, maybe 7 to 10% of your total wages paid, not, 20 to 30% of the total wages paid. Again, understanding those ratios helps you figure out, hey, is this even an accurate financial statement?
But also, I would think that if you had an audit from the IRS and they came in and they said, well, wait a minute, you've shown this cost here. You didn't really show the money you pulled out of their account and you put in here. And so now your taxes aren't going to be right, and we're going to audit you, and you're going to owe us XYZ plus.
At the very least, it's going to cause them to start digging, right? And when when they start digging, they're ending up finding record keeping that's not proper. And that's, you could be doing everything right, but I didn't keep these receipts. I didn't treat this weird thing right. I mean, I think now we have 3 different ways that meals are taxed, depending on who you're eating with and why you're eating a meal.
Yeah.
So there's a lot of complexity that was built, and that's on the tax side of things, right? That's not even on just your P&L, but hey, now I have one meals account. How do I properly handle that from a tax standpoint?
Yeah, I have to do 2 different meals account, because often I'm either out traveling and having a meal because I'm out, or I might be with a client having a meeting and a meal is a part of that. We actually have 3, because then we also do events where we provide food, which is a different tax category altogether. So
and shop owners, right? Hey, we're doing our lunches on Fridays to celebrate the week, and then we do our lunches on Thursdays for training. And then, hey, maybe I took a customer out to eat. Again, all have different tax treatments. It's complexity.
How many
not the purpose of this.
How many pages is the federal tax code now?
Oh, I think it travels around the world something like 100 times or something like that. If you lay them page by page, yeah. It's
like,
it laps the world so many times. I can't remember the exact number, but let's
see if we can bring it, make it smaller for shop owners here. What? Keep it simple, right?
Yep.
Make sure, and we have a sample, what do you want to call it?
Chart of accounts.
Chart of accounts. Yeah.
Yeah.
Excuse me. And you've seen ours, because I know I've sent it to clients and to you guys. And you guys do a good job of making those things happen for our clients. So keep it simple, right? Because I have the detail I can always print out later if I want to print out detail to find problems. And then what do you think is the biggest mistake, or the biggest top 2 mistakes that are made by small business owners trying to do accounting or bookkeeping?
Yeah. Well, the number one thing is they don't know what a balance sheet is, and they've never looked at it.
Yeah. By the way, I've seen 10,000 P&Ls, I've seen 10,000 balance sheets, and I can name on one finger the balance sheets that I've seen that were actually accurate. I have seen so many balance sheets where there's, what's this $150,000 here, right? And that was something that 25 years ago when we bought the business, that was something we quote unquote depreciated, or we did whatever. And it's this debt or something that's still hanging on and has not been accounted for at all. Yep. And do you think it's a laziness from the bookkeeper accountant person of just like, I'm not gonna spend the time to do that because no one's ever gonna really look at it, or it doesn't really make any difference?
I think there's definitely that, right? Hey, the P&L has a lot of effect. It has a lot of impact, meaning that's what's going on my tax return, and I'm paying tax on it. It's probably what I'm using to make my business decision. So it's got a lot of impact. Those are 2 very impactful things. My balance sheet, unless I go to a lender, right? A lender is maybe going to think what's my current ratio, right? Does my current assets cover my current debt? And then if they're like, hey, why do you have negative debt? How do you have negative debt? What is that?
And how does your balance sheet not balance? Right? I mean,
I've seen that a couple times, right? Fortunately, the softwares prevent you from doing that, but we see things on the balance. If a balance sheet is not accurate, the P&L cannot be accurate, right? Because if it's on the balance sheet, then it's not on the P&L.
Right.
Meaning it cannot be accurate. So in our opinion, that is by far the number one thing is we see pretty P&Ls and we see messy balance sheets. And then you say, well, as nice as your P&L looks, it can't be right.
So we have a question or two. Should I have discounts shown on the P&L? And if I do, should it be split from parts and labor? So if I am discounting, am I taking that money in and then taking that money out as a discount? What's your recommendation?
Yeah. So the discount line needs to be there, right? So we're going to show our gross labor sales. We want to know how much we're discounting. Now, whether to split it out between labor discount and parts discount, right, really depends on your policy. In this case,
if you're trying to look at parts margin, which we want to be 58%, and you're trying to look at labor margin, and as a loaded labor margin, I want that to be around 64%. Then I'm discounting either all in parts or all in labor, then I'm going to get some funky numbers, right? And that's going to point out to me some issues, but it'll be harder to put your finger on where the problem is, right? Somebody that's seen a lot of P&Ls and a lot of mistakes made will get it faster. But for a general shop owner, you're just not going to see it.
Yeah. Yeah. I mean, it really depends on the materiality of how you do it, right? If in this case, they've issued $2,000 of parts discounts through a year. Do I want to keep an extra line item for that? Probably doesn't make sense, right? We're going to have one discount line because we know how we run our business. We're going to discount labor, and that's their choice on how they're doing that. So that's how we're going to measure it. But
you also kind of wonder, was this really a discount, or was this like a bad debt you wrote off, right? Because of the way it's
how you handle it.
7 months with nothing, and then all of a sudden you got a couple of months with stuff, and
that's a good point.
I would be going. I'm not even sure that was a discount at this point.
Did
we account for a bad debt in the wrong place, right?
Yeah, and to me, discounts are a separate issue than parts and labor margin, right? Because we're measuring parts and labor margin at our stated rate, and then we have discounting, right? Discounting to me is a whole separate thing than pricing. Pricing is what am I selling my labor for? What am I selling my parts for? Then I have a discount, right? And I have an allowance, right? We probably set budgets on how much we're willing to discount at each month. And that's how I'm holding my discounts accountable to my team, is based on what budget did I set, and it really doesn't matter which bucket you chose it from at that point, right? Because that all ends up in the same gross profit. But you have to know that these are two separate different things. Because discount, right? Your labor rate's your labor rate. Your parts matrix is your parts matrix. Discounts is a separate action.
And I see shops that discounted $12,000 and didn't make $2,000 in profit. And you're just you're just shaking your head. There's a question here, Jensen. Did you say service wages is not in cost of goods sold? What I said is that I like tech wages. So I don't know if you're calling service wages. I'm not sure what you're saying. I like the tech wages in a cost of goods sold, but I want the service advisor, my sales cost, under the line in a like a fixed kind of where the fixed expenses would be separated out.
Agreed.
So yeah, got to have clarity around what you're talking about, but definitely for mine and for our clients, we want to see the technician wages and above the line, and above the line, below the line. So you have variable expenses, parts, labor, etc., and then you have fixed expenses, and variables are above the line and fixed are below the line.
Yep. Yeah, we're in 100% agreement. If you happen to move service advisor up into cost of goods, maybe that's just how you've always done it, how you have your historical data measured. You just need, now you've moved to the goalpost, right? So if our goal was 65% GP, now it might be 55% GP because we include service advisors. So you just have to understand the relativity of how you structure it. But again, right, if you're comparing P&Ls in a peer group, right, we want everybody to do things the same way. So we're measuring apples to apples. The more variability you add into how we measure things and what you're comparing them to, now all of a sudden you might have incorrect measurements.
And it's funny because I ran 20s groups for years, and we have quite a few here groups, and after, I don't know, 15 years, you find out that the one guy is measuring something in a completely absolute different way than somebody else is measuring it. And so you've been comparing this data. They've been in the group for 15 years, and you've been comparing data, And then all of a sudden, somehow you're having a conversation like, oh yeah, that's this, this, and this. And you're like, no, it's really not. So that makes it difficult. That's why we do the composite data stuff, so we can kind of decipher the data a little differently to make the peer group be able to have relative data.
Exactly. Yeah. Data hygiene is so important, and it's a big challenge especially when you come with industry-wide data, right? It has not been cleaned up enough as it has inside of a reporting composite like what you guys have.
So I've recently sent you guys, I don't know, 4 or 5 clients that it's really a mess. I mean, it's just a disaster. And do you, you said earlier that, bad data, as long as it's consistent, consistency is probably more important than being 100% accurate. Would you say like bite the bullet, get it cleaned up, and start moving forward? Or would you go back a certain period of time to try and clear that data up so that you can create a broader view of things?
I'm going to give you the perfect accountant answer. It depends. If I am somebody who is likely to go out and get debt in the near term, meaning I'm going to go do an acquisition, I might need to clean up a few years because I might lose my ability to go get that debt if I don't do that. But for the most part, 80% of the shop owners that come our door, it's more important that we focus on moving forward than going backwards. So I'd say 80% of the time we might, in those cases, we're going to start a brand new file, accounting file. We'll use the last filed tax return as our starting point and focus really on clean data going forward for the current year.
So is there any reason that I would say, okay, it's August, and we know that our financials are a disaster, and now I'm going to wait until December because that's the quote unquote end of my year.
I'd probably go back to January 1 and bring it forward through that current year. I might not go back and re-clean up, 2025, 2024, 2023, especially if we have a tax return filed. Again, unless, right, hey, I show losses in those years, that doesn't make a whole lot of sense to me, and I need to go out and get a loan from a bank, right? We might want to clean that up. Or, hey, I have people interested in buying my business, and we need good historical financial data. But for the most part, the cost of us going back and cleaning up prior years is too much. It's too much, and it's a distraction from getting the current information clean and right moving forward.
But I would say as a coach and consultant that I don't care if you're 25 or you're 85, and if you own a business, you should have a plan, an out plan. And if I don't have good, clean data, at least for 3 years, I'm not going to get paid for my business the way that I should be paid for my business. And so whatever you're going to do, in my brain, poor accounting, it could cost you hundreds of thousands of dollars.
100%
in the short term, really, and the long term.
Undoubtedly.
Yeah. And I don't know, I get a lot of, I don't know how often, but an awful lot of people saying, hey, I want to go buy this shop, or I'm looking at this shop or whatever. Hey, Cecil, what do you think it's worth? We do this a lot. And I'm like, okay, give me 3 years worth of profit and loss statements. Give me good balance sheet. And, let's run some reports out of the point of sale. I'd like to know what the average repair orders and a few other pieces of data. And then I can tell you with 3 other questions, pretty much within a few dollars of what that business really is worth. But if the data's, if I can't get 3 years, I had a guy in Northern California go to buy a shop, and this a few years back, and he's like, Cecil, I need you to look at it. And supposedly there was a few $100,000 of cash that was not on the P&L. And so the business is worth 800,000, but the P&L only supports 200,000. It doesn't support 800,000 because that money can't be accounted for.
Yep.
And the broker was arguing with me that 200,000 was legitimate and should be accounted for. And I was saying the bank won't account for it. I can't get a loan for it. So the answer is no. And it also clouds the other data. You know, when you're looking at, say, parts margin or labor margins, and you look at that business, you say, well, man, they're really poor. I know I can make them better because that's what I do for a living. And so I think there's hidden value in this business, but there isn't really, because it's $200,000 in parts and labor that you pulled off, that you paid for, but you pulled it off and took it in as cash. So those margins with that cash in there would have looked a lot better. And what we really found was that there were also, all the employees had been paid cash off the books for several years, because the guy I told not to buy the business bought it anyway and overpaid for it anyway. And it's scary what really happens and what you really see here.
Absolutely.
It scares the crud out of me sometimes.
I think we got
incoming question.
So, warranty. Oh, fun. Yes.
Great question. Go ahead.
Yeah, no. So this is important that you handle it properly in the shop management system. We don't use the discounting function to handle warranty, right? Most shop management systems have an ability to call other payment types. So, assuming you're talking about an internal warranty, right? We have a comeback repair that we're doing, or we offer a 3 or 36 on brakes, and we pay for the brake job, whatever it may be. We're going to have a other payment type. So we're going to write up that repair order, and what we want to do is kind of neutralize that effect on our gross profit margin. So we're going to write the parts around costs. We're going to write the labor around costs. So we might have a set rate that we use for what we do. Also, what we do to work on an internal, like a shop owned vehicle, or maybe, hey, me as an owner, my vehicle's owned by the shop. We're going to write those repair orders like that, because I still need to pay my technician. I still need to account for the part. So those need to go on a repair order. Exactly. Yeah. Now, if I pay my service advisor on gross profit and I say zero out that repair order, or I discount that repair order, now that's negative gross profit to my service advisor for something that, hey, they're not really accountable for. So we like to neutralize the effect on gross profit.
And we actually had multiple warranty categories that we paid out. So we had tech error, we had parts failure, and we had shop, giveaway, and we had warranty, legitimate, that brake job. We warranty it for 3 years. It failed at 2 years, and we're going to redo the whole thing as part of the warranty. Not anybody's fault. It's not really a part's fault. Not really a tech error. It's a legitimate warranty. So we had a minimum of 4 categories that we could look at.
Yeah, I like to keep that level of detail at the shop management system level. Maybe when it routes to your P&L, you might have one line for all those things that you're, I guess, quote unquote, eating, right? Because then we're looking at that, hey, I have a problem. Now we're going to go back to the source and say, okay, here's my 4-item breakdown inside my shop management system. And I'm going to then address, that's a performance problem. So I'm going to address it from there.
As a consultant, I like to know where the warranty's coming from, because then that can focus me in a direction that I can put a solution in place. But as far as the P&L, I just need to know that my overall warranty is below a certain percentage. And so I like to see that. And that's another reason why I like to have the percentages in the column. And I can tell you, even today, the P&Ls I get, and I see hundreds every month. Most of them don't have the percentages. I even got one last week where it was December, and then it was the total, but it was only December's total. So there were 2 columns, but it was the same column with no percentage. There was no benefit to a second column that's just a copy of the first column. Right? Yeah. And you just wonder why someone isn't paying attention to that who probably should. Right.
Yeah.
And is that my bookkeeper or my accountant's responsibility to go, hey, these are things that you should be looking at, or is that not?
So I will say we've ran into some limitations in the software inside of QuickBooks about being able to generate those reports with the detail that we like to look at. Exactly what you described, where you have like either a trailing 3 months or a year to date comparison along with a single month comparison with the percentages. Well, that's outside of the ability for QuickBooks to generate a report with that much data on it. So we use another software that plugs into QuickBooks Online, in which we can further customize and build our deliverable with those different reports like that. Because we also found that issue of, hey, if we can't add percentages here, you lose some relativity to that report.
And for me, the financials, I mean, obviously I want to pay my taxes and I don't want to be audited. And if I'm audited, I'd like it to be clean.
Yeah.
I cannot tell you how many shops we've come in. I can give you at least one example. Father and son, they owed the IRS $300,000, and I'm looking at their P&Ls, and their accountant or bookkeeper had been double accounting income. So the income that they had reported and stated was not the income that they really had. And so when it was all said and done, we kind of sent it through what I would call a forensic account. We cleaned it up. Yeah. They really didn't owe the IRS much.
You only have a 3-year statute of limitations to correct that. Yeah.
And and I've seen that happen a lot of times too, which makes me a little nuts. All right, I think we had like a last question. I think we're getting to the end of this thing. Credit card processing fees charged, separate line. I always have credit card processing fees, and there should be a line for it as a cost in below the line.
Yeah. So they're talking if they charge for that. So if they charge for the fees, they pass it along. There's a few different ways to do it. I do think that that's now an income item, right? And we might actually bring up the cost, or we might even apply the cost against that income because it's really a pass through at that point. So we might have
an interesting philosophy. Yeah.
Yeah. Yeah. So if it becomes a pass through because we charge for that credit card fee, we might only record the net additional or cost that we have.
So you're saying I'm going to report the $4,000 ticket as an income, but I'm also going to report the, I don't know, $40 that the credit card company is charging me to do that $4,000 ticket.
Yeah. So if we charge, say, $50 in a credit card fee, and it costs us $40, right? We'd have a net $10 of income, and we might report it just as a straight net $10. Again, that's a little bit newer, and we're still trying to understand how that really relates to how we do pricing, how we analyze gross profit, things like that on a financial. I think maybe the last 12 months is when people have started really adopting, we're going to pass on credit card fees to our customers.
Yeah, I see that too. And it's I'm seeing it the question's coming up more and more. We haven't primarily in the past, but the question is coming up more and more now. All right, before we wrap it all up, we have this financial intensive April the 23rd,
23rd and 24th.
Yeah, I think it's 23rd and 24th. It might be 22nd and 23rd, but I'm pretty sure it's the 23rd and 24th. They told me before
24th.
Yeah. Okay. Yep. And this, we're going to be really teaching the importance of good accounting, good bookkeeping, and also the things from the coaching perspective that you need to look at and what they mean to you and what that. So I can look at a P&L and I can say, we have a problem with parts, the way we mark up parts. Or I can look at a P&L and say, man, we're not charging enough for our labor because of the variance between parts and labor as a percentage. And so we're going to be teaching, like, we're going to get into the nitty gritty, but without getting into the nitty gritty. It's not going to be an accountant thing where we're going to go through every line and go line by line. We're going to be really teaching the basics in how to really understand your business in a financial model. and you guys are going to participate in that, which is fantastic.
We're excited.
We're already have quite a few people that have signed up for that. If you use the QR code here, you can get signed up for that. It's I don't know, I think it's I want to say 2-day class, but it might be 3. I think it's extremely reasonably priced. And we'd love to see you here in Utah for that. And I'm excited about it because this is like my Jones, right? This is my crack cocaine is looking at the numbers and I'm not an accountant by far, and I don't know that I could be, but understanding the business numbers for me is like it's crack. So
you understand the impact it has on that business, their wealth generation, how it helps their technicians, their employees that work for them, and hey, even the community that shop participates in. Right, a more profitable, better shop is going to really have a better effect on the community as a whole.
And I always say there's like for the average shop, the typical shop right now is making about 4% net. Institute shots a little over 18. We vary between 18 and about 22 for our shops. But about half the stuff that you're going to do to make money to fix that, pretty simple. The other half's a little more complicated, and you really need to understand your business like it's an engine, and you need the right amount of fuel and air and spark at the right time. And if you understand those things, it can make you not just thousands of dollars every year in profit, but it can make you tens of thousands or hundreds of thousands of dollars when you go to sell your business or pass it on. Yeah. And so, the Institute, better business, better life, better industry. We find that the more profitable the business is, the better the owner understands it, the better they can manage people, the more money they make, the happier everyone is. And so, so please consider coming to the financial class. And Eric, we'll do this again here in the near future. And if you do have questions that didn't get answered, pass them in, and we'll do our best to get you answers for those. Thank you very much for your time today, Eric.
Yeah, of course.
We love you guys over at Kaizen, and I hope I pronounced it correctly.
I think you got it.
Clay doesn't shoot me. And thank you for those of you that attended and had questions. Thank you very much. We'll see you next time.
Thank you so much. Thanks, everybody.